Hi guys, it's Jordan, and today I'll be discussing one of the fundamental accounting principles, the revenue recognition principle. First, I'll give you a quick overview of the principles and standards which guide the recognition of revenue. Revenue recognition is an accounting principle included in the generally accepted accounting principles, which determines the specific conditions under which revenue is recognized or accounted for. In Australia, the rules which govern the recognition of revenue are included in the Australian Accounting Standard AASB 118 Revenue and the framework for the preparation and presentation of financial statements. So you may be wondering, what is revenue and what is the revenue recognition principle? According to the AASB, revenue is the gross inflow of economic benefits during the period arising in the course of the ordinary activities of an entity. The primary issue in accounting for revenue is determining when to recognize revenue. According to the revenue recognition principle, a revenue should be recorded in the period in which a resource has been earned, and not just when the cash is received. So, when is a revenue earned? According to the AASB, revenue is earned and can therefore be recognized when it is probable that the economic benefits associated with the transaction will flow to the entity, the amount of the economic benefits can be measured reliably, and the stage of the completion of the transaction at the end of the reporting period can be measured reliably. The following examples will demonstrate the application of the revenue recognition principle and thus when to recognize revenue. JC Sound Co. rents DJs and has the following transactions during the month of May. On May the 2nd, JC's agrees to provide a DJ for a party to be held on May the 10th. The customer agrees that payment will be made on the date of the function. So the key question to ask here is, can JC recognize any revenue on May the 2nd? And the answer to this is no. JC's cannot recognize any revenue on May the 2nd as no revenue has been earned. In this example, JC will recognize the $300 of revenue on May the 10th when the service is provided and the payment is received. In our second example, on May the 5th, JC provides a DJ for an 18th birthday party. The customer agrees to pay within 30 days. So, can JC recognize any revenue on May the 5th? In this example, JC has provided the DJ and has therefore earned the revenue, even though the customer has not yet paid. This is an example of accrued revenue, which is when cash is received after revenue is recognized. You'll learn more about this when you study adjusting entries. In our third and final example, on May the 7th, JC agrees to provide a DJ for a birthday party to be held on May the 20th. The customer pays for the machine today. Can JC recognize any revenue on May the 7th? JC has received the cash from the customer, however they have not yet provided the DJ and therefore they have not yet earned the revenue. JC needs to record the cash they received, however they can't recognize any revenue on May the 7th. This is an example of deferred revenue as cash was received before revenue can be recognized. This concept will also be discussed more when you study adjusting entries. Thank you guys for watching. I hope this has been a helpful summary on the revenue recognition principle.